Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. Good morning, everybody, and thank you very much for joining. Well, it's been another interesting month as far as the financial markets are concerned. I'm pretty sure that when we did the April webinar, we were talking about possible downside risks to the pound against the US dollar and also against the euro, but I don't think we envisaged quite the sizable declines that we've seen in both of those currencies. So as far as the webinar today, it's just me. It's not going to be Piers today, but we'll welcome him back next month. And we'll be looking just at the macroeconomic outlook and how that has changed with some of the things observed over the course of the last month. We'll take a look again at the foreign exchange markets and particularly some of the developments outside of the major macro currencies, looking at instead one of the interesting developments as far as the Chinese renminbi when we get to that slide. There's not a big slide deck today. It's only 4 or 5 slides, so there'll be plenty of time for questions, and I hope that you're already teeing up those questions in terms of what you think is important or pertinent to your businesses. So without further ado, let's get on to the slide deck and go straight into the content slide. So what are we seeing as far as the macro environment is concerned? Well, we've seen some surprising numbers as far as Q1 GDP growth were concerned, and we'll get more Q1 GDP growth numbers on Thursday. We'll look at the outlook for inflation in the wake of the rise and then decline in some of the inputs into consumer price inflation, particularly energy prices, which have been very volatile over the course of the last month or so. We'll look at how interest rate expectations are changing. Well, maybe not changing that much yet, but they are changing a bit before, as I say, moving on to foreign exchange markets and looking at what the US dollar has been doing over the course of the last month or so. So moving on to the next slide, you will see from the table on the left-hand side that the US produced a surprise drop in quarterly economic growth in the first quarter of 2022. So it was expected on a quarter-on-quarter basis to be up around 0.2, 0.3 percentage points. Instead, it fell by 0.4 percentage points, so a larger drop than was anticipated. But remember that the fourth quarter numbers outperformed expectations also. So it was in part a reversal of the very expansive growth that we saw in the fourth quarter. For Euroland as well, there was a slowdown in economic activity. I think both the US and Euroland growth numbers were adversely impacted by the reintroduction of some restrictions around COVID that took time into the first quarter before they were reversed. But it's noteworthy that as far as Euroland growth is concerned, their GDP level is now back above where it was pre-pandemic. They're the last to have seen that reversal. The US and the UK getting there a number of months earlier. In the US's case, they're around 6 percentage points above their pre-pandemic levels, even with the drop in quarterly GDP that we saw in the first quarter. Now, the interesting thing as well, though, is that there are other signs of a slowdown occurring. So we've seen this in labour markets, for example, some misses as far as labour market figures are concerned. And the US non-farm payrolls data that was released only last Friday did demonstrate a rise in underemployment and also a drop in labour force participation. So that's worth keeping an eye on to see whether this is the additional impact of price rises starting to bite in terms of investment plans, both capital and labour investment for businesses. Overall, though, the slowdown in economic growth is perhaps a quarter or two earlier than central banks were anticipating, and that might change some of the decisions that they make in the future. So if we move on to the next slide, and this slide demonstrates that we've seen further additional upside in inflation. It looks now as if we may have peaked as far as US inflation is concerned at around about 8.5%. That's 30, 40-year highs as far as inflation rates are concerned for the US. That said, I don't think we've yet reached a peak as far as UK or even Euroland inflation are concerned. There is still additional upside to come. There's still some hangover effects from the rise that we saw in energy prices over the course of recent months. So watch out for that, because we could see a switch around in terms of inflation rates as the US inflation rate starts to decline. UK and European inflation rates actually overtake them. The global inflation as well might hang around for much longer. So we're still hearing of a number of supply chain problems, and those supply chain problems have intensified in recent months because of lockdowns in China. So expect that to have a material impact over the next sort of 4 to 6 months in terms of the supply of goods and how consistent that supply is able to be. Moreover, we're still hearing tales of stockpiling by businesses because they're worried about when they'll get their next supply of goods. So consequently, that stockpiling, I think, will maintain a level of elevated inflation going into the second half of 2022, possibly really until the end of the first half of 2023. And it's worthwhile mentioning on this call that we do a regular half-yearly survey of our SME clients, and they're telling us that they think that the price rises are going to continue and inflation will remain elevated well into 2023. In some cases, about a quarter of our clients responded to the survey said that they thought that the inflation will remain elevated until 2024. So worthwhile noting that is far in excess of what we're hearing from central banks. But clearly they are finding it difficult to pass on the full effects of that inflation through the supply chain. So that's another factor that's likely to reduce profit margins and reduce investment intentions, in my opinion. Moving on to the next slide, and we haven't seen a huge change in interest rate expectations. We have seen interest rate expectations come off their peak for the likes of the UK and the US, but worthwhile noting that as far as Euroland is concerned, the talk has intensified recently. Indeed, as far as the outlook is concerned for interest rates in Euroland, I would suggest that over the course of the last week to 10 days, the prospect of a July rate increase has increased materially, whereas previously the anticipation was that we'd get to around about September before any sanctioning of tighter monetary policy would be introduced. Remember that in terms of the bond buying program, that's only set to be wound down by the end of the second quarter in Euroland. So it gives very little time for the markets to adjust from a period of monetary loosening to a period of monetary tightening. But clearly, amongst some central bankers in Euroland, there is a real concern that inflation is out of control, and they need to press pretty hard on the brake, on the economic brake, in order to control second round inflationary effects, albeit that there doesn't seem to be much signs of those second round inflationary effects leaking into the Euroland economy at this juncture. As far as the US is concerned, the Federal Reserve sanctioned a 50 basis point rate increase going back to the May decision, the early May decision that was taken last week. That came alongside a further 25 basis point increase from the Bank of England. So both central banks now have interest rates at 1%. But you'll notice quite a material divergence in the peaks for US and UK interest rates. So UK interest rates peak in and around about the 2.25% to 2.5% region. US interest rates are set to peak above 3%. And I think that is clearly very interesting as far as how we think things will evolve and materialize over the course of the remainder of this year and into 2023. Both central banks are unlikely, in my opinion, to hike rates as much as the markets have priced for. So there's room for disappointment, and that could have an impact in terms of how currency markets trade into the remainder of 2022 and early 2023. So let's look at those forecasts as far as the foreign exchange markets are concerned. On the next slide, you will see that the forecasts have changed somewhat, but it is difficult to keep pace with how quickly the markets have been moving. So our forecast for sterling dollar and euro dollar have been revised down materially in the short term. I think in the longer term, there are going to be some recurring issues for the US, particularly around how much is already priced for as far as interest rate hikes are concerned, but also a very sharp slowdown in economic activity to come, which might put significant pressure on the Federal Reserve to reduce interest rates as we head into the early to middle stages of 2023. And I look back to 2019 and the beginnings of 2019, when the markets were very confident about US interest rates going above 3%, only for the US economy to lose virtually all of its economic momentum. And the Federal Reserve were cutting interest rates from a peak of 2.5% rather than raising them any further than that. And for the UK as well, I don't think that interest rates will rise much above 1.25% to 1.5%. We certainly think that the August meeting will be the point at which the Bank of England signal a pause in monetary tightening once they've raised rates to 1.25%. But even that interest rate increase isn't set in stone. And if the economy does considerably worsen from here, then I think the Bank of England would reconsider their decisions on monetary policy. The hawks amongst the Bank of England Monetary Policy Committee are starting to lose their sway over those members that are potentially persuadable in terms of their monetary policy decision making. In terms of what this means for the currency markets, I think there are still some downside risks for sterling dollar in the short term. We don't necessarily think that the 122s that we visited recently are the lows, and we could see a low as low as 118 in sterling dollar over the coming months. And in euro dollar, there is an increasing risk of a move down towards parity. The euro, despite some of the increase in interest rate hike talk from European Central Bank members, hasn't really recovered that much of its lost ground against the US dollar. And the US dollar, in fact, has hit multi-decade highs on the dollar index basis, and also against the yen, where we've seen it rise up towards 130 in recent sessions. But the other currency that I wanted to focus on a little bit is the moves that we're seeing in dollar China. And the reason that I think that's interesting is because we weren't expecting the dollar China rate to move just as aggressively as it has. Normally, the central bank would be intervening to prevent a big move in the Chinese renminbi. But we've moved from sort of the mid 630s all the way up to above 670 recently. And so I think that the Chinese renminbi is trying to remain competitive. It's obviously the authorities are observing some of the weakness that we've seen in the pound and the euro against the US dollar. And consequently, they have been more willing to allow a weakening of the Chinese renminbi. Will that persist over time? Well, if we do get a bounce back in sterling and euro against the dollar, I think you would see dollar China then starting to pull back towards a sort of 660 or even 655 region. But at the moment, the weakness of the Chinese renminbi is actually mitigating against some of the global inflation that we've been experiencing. So it's worthwhile just noting that, because I do think that could put a bit of a lid on global inflation over the coming months and quarters. Noteworthy, though, that it's probably going to do more in terms of reducing inflationary pressures in the US than in the UK and Europe, because they've experienced their own currency weakness. Overall, I think the markets are more volatile. We've seen additional volatility in emerging markets recently. We've seen some surprising strength in the Russian ruble. But that driven by a requirement from those that are operating in energy markets and buying Russian oil and gas to pay in rubles. So I think it's a bit of a false dawn as far as the ruble is concerned, and we could see renewed pressure on the Russian ruble when we start to get the economic data released from Russia, which will likely show that things are very bad way as far as economic activity is concerned, and a sharp reduction in levels of GDP as we head through the remainder of 2022. Just one final point. I think that the volatility that we've seen in energy markets is going to persist. It's worthwhile noting the roller coaster that we've been on as far as natural gas prices are concerned. We've seen a big fall in natural gas prices recently. I think that's actually associated more with the warm weather than it is underlying levels of demand. But equally as well, gas storage was refilled at much higher levels of gas prices than the ones that we're experiencing currently. And that may mean that the pass-through effect of improvements in the gas prices onto energy prices will take many months or even many quarters. But volatility is still critical as far as the financial markets are concerned, and FX markets in particular. It's likely to remain elevated for the foreseeable future as macroeconomic conditions worsen and also as liquidity remains stressed. So I do think that it's worthwhile making mention of both of those things if you're looking at your plans. Remember that although things like sterling have fallen quite a long way against the US dollar, it could get worse before it gets any better. So take that into account when looking at budgets for the coming quarters and years ahead. So that's really it in terms of the macroeconomic update. I hope that's been of interest. Just leaves me to say thank you all for dialing in today. We hope that you've enjoyed the content, if it hasn't been necessarily the most optimistic. The next call is due on the 8th of June. And as I've mentioned previously, we'll be rejoined by Piers Leslie from Fact Not Fiction Forecasting Limited. And we'll look forward to seeing you on that call. It just leaves me to wish you the best for the rest of your day and week. And until we meet again on this call, I hope that your businesses continue to succeed. But thank you very much for dialing in.